Hey, welcome everybody to the 40 Finance channel. Checking in here. I took a little week off during Thanksgiving or right after Thanksgiving, so getting back in line here. And frankly, since I left, which has probably been about 7 or 10 days since I posted, the market has kind of taken a downturn. If you look over here on this chart, at least for the NASDAQ, coming out of Thanksgiving, call it right here, or the first part of December, we had a nice little boost, and that has since melted down. And, depending on who you talk to, everyone has their opinions on what's going on. For myself, the thing that I'm having the most trouble with is just how, good economic news is considered bad, and bad news is considered good for the future of the stock market, right? Everybody is pinning bad news, right? Let's just call it layoffs, things like that. Everyone is calling bad news the categorically good news because they think that's what it takes for the Fed to stop doing their interest rate hikes. Okay, and the problem is when you see headlines like this, where non-farm payrolls show job growth still chugging along strong in November, these types of headlines actually bring the stock market down on days. So to me, I think we're a little ass backwards, if you will, on the way we look at economic items. And that's what we're going to go through today. Go through some different headlines and talk about, what does it really mean? I think for the most part, when Powell did his press conference last week, it wasn't super positive. Like, he wasn't smiling and excited that everything was turning around. But he did imply that he's finally starting to see some economic signs of inflation coming down. And while that might not signal the direct bottom here in the stock market, I do think that we should perk up a little bit. And if you are a long-term investor, start thinking about what the implications are between now and, let's just say, spring or summer of next year. What is the opportunity? In my case, just to come out straight, like I've been saying for a while, DCA, buy a couple shares here and there, take advantage of what's going on now, because if this thing does turn around, like we've seen on certain days, the stock market could go absolutely insane to the upside, and you'll miss out on the good days. So, Lion, what's going on? Good to see you. And let me show you a quote. So I don't know who this person is on Twitter, but I read it this morning. It was a response to something else, and I think it's pretty funny. And it sums up, honestly, the way I feel. Oil up, bad. Oil down, bad. Stock market up due to inflation, bad. Stock market down, bad. Housing market, crazy unaffordable prices, bad. But people say it's good. Housing market corrects, that's bad as well. Cars inflate, bad. But people say it's good. Cars correct, bad. And this really just kind of puts into context the way I feel too. Like, I don't think that there's this actual, people don't even know what they want the news to say from an investing standpoint. All they care about is Fed and interest rates and turnarounds, where the fact of the matter is there's a lot of stuff going on underneath that could be good news depending on which stocks you own. Don't forget that I did a video maybe 60, 90 days ago where I talked about how corporations prepare for recessions, and where you tend to think about recessions being bad for corporations, they do have levers in their pocket, right? They do have job and benefit cuts at their disposal. Some of them have price control, where they can raise prices slightly. And I know, like on the consumer side, I know Disney Plus just did that. Google's TV, forget what that's called, YouTube TV or whatever. They just did that. I think we've all seen price increases across the board on different things. So when you have control of pricing, you can make up for some of these challenges that are going in the world today from a corporate standpoint. You also have the dollar, and I don't know if I can get the dollar to show up on here. I'm not going to screw around and waste your time, but you also have the US dollar that has been ridiculously strong over the past, call it 4 or 5 months, and even that's starting to very slowly come back down to average, so to speak. That is huge news for international companies who, at the end of the day, all we really care about as investors is earnings per share and revenue growth. Right? Revenue growth, that could be the one that is the harder one coming out of any sort of recession, just because depending on what stock you're in, consumers may not be able to spend as much. But EPS growth is a whole nother ballgame that you can manufacture as a corporation simply by cutting back in certain areas. Lion says, after a year, my job recalls me finally. I didn't take the jab. Let's put those paychecks into the market. Absolutely, for sure. And, if the labor thing that I was getting at here, and this is a reverse or a contradictory headline to this one, right? So non-farm payrolls show job growth, and that's on December 2nd. The next headline here, number of job cuts surges in November, led by tech, and that's the type of contradiction that's out there today. Depending on where you stopped while reading the news updates, you may not have seen this, or you may have seen this one and not this one, but they tell totally different stories. And that's why you have to, quite honestly, think for yourself. Either think for yourself or get the widest range of opinions possible, and don't get stuck into, one person, particularly someone on the media, whether it's me or YouTube or CNBC. Don't ever get stuck with one person telling you what to do, or one person telling you, going through all these steps of why their opinion is the best. You need to get as many opinions as possible. I always share mine. But I never come on here and say that I'm releasing the 10 Commandments. It's just the way I look at stuff. Let's take a look at some other headlines here. Rent. So Powell talked about this a little bit. The rent index, this was on November 30th, falls by the largest percentage since at least 2017. This is from, I'm guessing, a website, Apartment List. Let's see if they give an actual number. The year-over-year pace of rent increases is also moderating. From January to November, rents rose 4.7%, dramatically less than the 18% growth experienced in 2021. So still going up, to be fair, but the rate of increase is slowing down. Vacancy rate increased to 5.7%. from a low of 4.1%. This would be good news because, ultimately, the more vacancies that an apartment complex has, the more pressure there is on them to lower their prices, because similar to hotels and event spaces, the worst thing you can own is an empty unit or empty space, right? Because after each period goes by, you're actually losing money, and you're better off taking less rent and putting someone in there. While rent is falling, it will take a while before it filters into inflation numbers. Jerome Powell said in a speech on Wednesday that housing inflation tends to lag other prices due to the slow rate at which the stock of rental leases turns over. He expects overall housing services inflation to continue rising into next year. But as long as new lease inflation keeps falling, we would expect housing services inflation to begin falling sometime next year, he said. Indeed, a decline in this inflation underlies most forecasts of declining inflation. So that was a good summary. And let me see, this is oh God, this is the speech. I'm not going to go through that one today. But like I said, indicators are out there, right? And it just depends on which, how are you looking at the news? Are you reading news with an open mind? Or are you reading news, with somebody giving you the news and telling you what to think about it? Consumer borrowing grows less than expected in October. Consumer credit expanded by 27 billion versus 28 billion consensus and 25 billion the year before. Total outstanding consumer credit of 4.7 trillion rose. 4.73 trillion rose from 4.7 trillion in the prior month. Revolving credit, which includes credit card debt, increased at a seasonally adjusted annual rate of 10%. And non-revolving credit, which includes auto and student loans, advanced at an annual rate of 5.8%. There's a lot of speculation in credit markets right now, particularly, the pressure that could be coming on auto loans because so many people purchase new cars at, let's just say, inflated prices. And will they be upside down in those vehicles, so on and so forth. And you could make the same argument on housing. If you purchased a home, say in 2021, do you go underwater on that property? And I guess, another take on that, though, is if you did purchase a car, for example, there's an element to cars that you're underwater anyway, unless you've put a down payment and paid your taxes in advance on that. So you're not really underwater until you go to trade it in. And if you're going to keep the vehicle through the life of the loan, then underwater is really just like a paper equation. What comes into problems, of course, though, is if you purchased a car with a payment that's higher than you can afford to make, or perhaps you get your job cut or something. Then it starts to get a little bit more serious. But I would just say rolling around with a car loan that's underwater isn't necessarily the greatest feeling in the world, but assuming that you have the money to pay that monthly payment, then you really don't have a whole lot to worry about, right? And then it's just kind of like dumb luck that you're just waiting, you're just driving around with an underwater car. And hopefully you still enjoy that. And a lot can be said in that realm for housing as well. So if you bought a house today, last year, and let's just say for fun, by today's standards, it fell by 5%. Okay, so we'll say you bought it for $205,000 or $200,000, and it's now worth $190,000. So technically underwater, right? Particularly on the snail's pace that mortgages go towards equity. Well, that doesn't make you feel super good as a homeowner, but does it really matter in the grand scope of a 30-year mortgage? Probably not. I would say, my argument would be if you're in that home for a minimum of 5 years and you're living in that home and you're providing housing to you or your family, then it being underwater versus the loan value probably doesn't matter that much. And in that situation, that you have options down the road, 5 to 7 years, certainly you'll be able to look at refinancing options by that time. And then, of course, in the great housing shortage that no one seems to talk about, you have the opportunity probably that the value of that home will go up. So underwater is, underwater is in the eye of the beholder, and it's only going to kill people who can't pay their bills, right? And certainly there'll be those people. Those people are out there, and American consumers are good to fall into that rut here and there. But don't let things like car loans that are stated underwater. Don't let that headline rock you too much, because it only matters if you can't pay the bill. What's up, Derek? Love for the 90s. Good to see you guys. Let's see what other headlines we have. Just doing a sort of economic good news is bad news thing today. Here's the latest news on Seeking Alpha. As always, the Seeking Alpha sale is still going on in December. I thought they were going to end on December 1st, but my affiliate link is in the description if you guys are interested. Great deal, $99 a year. Let's see what they have on our latest news now that the market is closed. And I'm in all news, so I want to get down to the economy news. All right, 98% of CEOs predict a recession in 2023. That's great, and I sort of wish we would just get to whatever this definition of recession is as soon as possible. My guess is for everyone to agree on it, it's going to have to come in January, right? We're going to have to get the January, we're going to have to cross January. We're going to have to have somebody anoint the fact that the holiday shopping season was a spectacular failure, and start to talk about all of the reasons that the consumer is hurting, et cetera, et cetera. And then maybe we can just agree on it and move on to more constructive matters. So if I had to guess when the worst of the worst news would possibly come out, then I would say January, February. But if as an investor, I would say, in that same time span between now and let's just call it March or April 1st, I think that you should be taking your own calculated risks on quality companies with earnings for the long term being 3 to 5 years. I just don't see how, if you follow that simple formula, you won't come out ahead in the long run. All right, so 98% of CEOs. What else do we have? How about crude oil? I'm just going to highlight that here. It's in this chart. I'll do this little hover. Over the past month, what a sinking ship, right? And I believe, so there was a great run. Congrats to anybody who got in the oil stocks, let's just call it in January, right? And we see what happened through June, and it's been sort of down ever since. I did not purchase oil stocks. It's a commodity play, and I'm not super comfortable with commodity plays, really for this reason. Because we can never quite identify on commodities when the bottom falls out. This isn't a great look for oil right now. However, if you bought an oil stock in January, let's pull up an oil stock. I'm just going to pick Exxon because it's one of the few that I know. Not suggesting it's the best one. And here's your 1 year chart. So if you got in here, $60, all the way up to, call it $76 or so before it really took off. And look at this boom town at the trail end of the year. Now oil's coming down, so I'm sort of surprised we haven't seen it. These prices go down a little bit more. 30-day chart shows it a little bit, but I don't know. Do you start thinking about selling your oil stocks at this point? Not because oil collapses, but maybe you take that last dividend and you say that the rest is probably going mostly to the downside. I don't know. I wouldn't be able to advise because it's hard for me to speculate where things go from here. I read an article once that said any time oil is above, I think it was $60, that anything over $60 was like 100% profit for the oil companies. And even today with the downturn, it's like $72. So it's right there. But, speculation on my behalf for the next 2 years is Republicans probably have a pretty strong shot to come back into play after the next election. and then you start opening up America's pipelines again, which I think, my opinion, that's a good way to do things, because relying on the foreign oil, as we know, has been treacherous here in 2022. All right. What else do I have for you today? Oh, yeah. Here's another economic good news. These are shipping containers, right? Shipping containers from China to the west coast of USA. You can see, you don't even need to zoom in on this one, how far those prices are down. And I've actually heard, I think on CNBC, that there are ports on the West Coast that have a problem with empty containers and nothing to do with them. So obviously we had this huge run up in freight and shipping coming out of the pandemic. Now there's actually a problem that there's too many empty containers and there's nowhere to put them. So I wish I had the source for you, but I can just tell you that I heard that story somewhere. And this is good news for, inflationary price pressure, right? Because we have, what would seem to imply that we have a lot of overstock, and overstock typically gets marked down as time goes on. And I would figure that January, February, we will see a lot of markdowns coming off the holiday, especially if the consumer is in the shape that many people act like it is. All right, so heading into the end of the year. Now, the big decision that I have heading into the end of this year is with having plenty of losers to choose from in my portfolio. I have to think about which ones I'm going to part ways with for the tax loss harvesting. And I was adding it up the other day between a couple different accounts, and I don't have to, but I should try to sell north of $10,000 worth of losses. So that's not necessarily $10,000 worth of stock, that's $10,000 worth of losses to cancel out some of the small victories that I did have in 2022. So I had to start thinking about that a little bit. I'll do a video on it eventually. It won't be anything with QQQ, or if you follow the channel for TQQQ, I'm not selling those positions. It would have to do with individual positions that I have to balance off. And surprisingly, out of nowhere, even though I'm up for the year on things that I've sold, like realized gain loss, I am not up at all on my portfolio. But some time ago, I bought into a small lot of the China Internet ETF. This is when I sort of felt like Alibaba had just fallen to the ground. It must have been back here in October. And I bought some of this, and I think I was at the $30-ish mark. So I don't know when I jumped into this. But long story short, this thing has come back because of the Chinese COVID rules that they're reversing. So this was one that I was just going to sell out and just take, towards my capital gains losses. But I could actually go positive on this if we ever have another bright market day. Today was down across the board from a NASDAQ perspective, like a 0.5%. So I think what I'll at least do before I sell it is wait till a green day and let it come back a little bit. But I could actually make a couple bucks off that, which is good news. It would also influence, it could add more tax gains for me to knock off. So I'm in a weird place here at the end of the year, and I have to kind of come up with what I'm going to do with that. So, so that's the latest As far as things that I've been talking about, let's take a look since we're here on the top rated stocks from Seeking Alpha. I always like to eyeball these. And now that oil, let's see if it's still all oil. Because there was a stretch when they were doing a ton of that. This is based on quant formula, okay? And I say it all the time, but I do like to look at the quant formula for Seeking Alpha. It's not something I've ever traded on, so I don't want to make any false promises that you should just run out and do this because of the quant formula. Vista Energy, this looks like it is a foreign company. And let's take a look at their last month. Been sort of up and down, minus 9%. And we'll scroll down here, see where they're at. They are in Mexico. Exploration and production of oil and gas in Latin America. All right, that's not the type of thing that I invest in, but, you know, consider it a freebie that I showed you that. They are at the top of the quant score right now. Let me make a slight adjustment here. And what I wanted to do, first of all, let's change our country. Oops, market cap, that's what I was looking for. Market cap, just to get a little bit bigger company. Let's go with 3 billion. 2, 3, 4, 5, 6, 7, 8, 9. All right. Now that'll at least get rid of some of the really small stocks we don't know. I did also want to change. I was going to change the country to America, but why don't I just leave that as it is? Long story short, here we go. This is 3 billion market cap or more. And you have Super Microcomputer at the top of the list. And it looks like that's been on a heck of a run, so I don't know if this ship has already sailed. When we had a big run up in mid-November, it went from 77-ish to 94-ish. Let's see what their story is. United States develops and manufactures high-performance server and storage solutions based on modular and open architecture. Solutions range from server storage, blade servers, racks, network devices, and it's got the website here. Let's see what we got. Okay, so basically, if you know, I'm making this up like I know, like I know this. But this, you know, building blocks, the industry's broadest selection of high-quality hardware for fully application optimized servers. So I'm going to call it data warehouse type equipment. So I'm imagining when people buy this stuff, who's ever buying this stuff, I would imagine that their invoice has quite a bit of money on it. It's interesting that this time, you know, that this is sitting at the top because you'd have to guesstimate that a lot of folks would say that companies would be scaling back from this type of investment in the short term. So CapEx, right? How much money companies put towards growth initiatives and fundamental replacement initiatives. I'd have to say that this would seem like a tough time for that. But I haven't dug deep into the stock before. Now, the one thing about CapEx that we should be hearing about very shortly is it's going to be interesting to see how companies budget for that. Okay, so as we enter 2023, anybody who runs on a traditional Gregorian calendar, their budget starts on Jan 1, right? So that they've likely allocated what they're doing for research and development, CapEx, marketing, all those things. They've probably assigned that money already. So we should find out late December, early January, how that CapEx budget is trending versus what was spent in 22. And then, of course, we can compare 22 to 21. My guess is it came down significantly in 22, but perhaps more importantly, where's it coming out of the gate in 2023? Because companies like Supermicro Computer, let's just lump in the chip manufacturers, everybody like that, they are going to be impacted by how much big corporations spend on swapping out their technology. All right, back to the top stocks board. We got a biotech, which I'm going to skip because that's a very wacky world of approvals. NatWest Group, high risk of cutting its dividend, is what it says here. Let's see what they do. Banking and financial products, commercial, institutional customers in the United Kingdom. And if we go on the 1 month, it has grown significantly on the 1 month. So if you're scoring the quant formula from that degree, I just don't know enough about this one to invest into it from a long term. That's one reason too, if you're on this and you're looking at quant scores, you get a lot of momentum with that influences quant scores, right? And I'm not really a momentum trader, so that's one reason I don't follow it. United Airlines, the airlines are to me really interesting right now because they've had a bit of a tough stretch, or a stale stretch, I guess you could say, coming out of October, even though most of them are, looking much more profitable considering what they sat through in 2020. And as I say that, I read this article. Airline stocks fell back on Wednesday as investors turned cautious ahead of next week's big meeting. Central bank is expected to boost interest rates, blah, blah, blah. Is the recession sell-off overdone? Morgan Stanley called 2023 a potential Goldilocks year for the airline sector with market conditions just right. Firm said the last 3 years have seen extremes, 2020 and 21, and 2022 was too hot with pent-up demand and inflation. On the cost side, Stanley said capacity constraints, inflation, and jet fuel pricing have also been running either too hot or too cold. So that's the Goldilocks reference. Perhaps 2023 for the airlines is sort of the just right year. We'll have to see. I have a tiny stock, Sabre, that is connected to airlines in some ways because it's essentially the reservation system. No luck on that one in 2022, despite everything coming true that we already knew, right? We knew that travel was going to go through the roof. It started on like March 1st, and travel was absurd through all of summer and everything, but it wasn't enough to at least pump Sabre. It looks like if you had to look at United Airlines, overall, let's see year to date. Year to date, United Airlines minus 3%. Okay. I haven't gone through their financials, but I will say, considering the demand that we saw in travel, it's pretty odd that this one's going to land basically at flat or just a notch below. So travel stocks are really, really interesting right now. Just for fun, since we're on the topic, I'm just going to type in Hyatt because it's the first thing that came to mind. Year to date on Hyatt, flat, 0.06%. Let's see what kind of projections we have on this one. I got to get there here. All right. December 2022, figuring to come in at about $1.10, which is an 87 PE. Maybe next year's 259. So that's only a 37 PE. And I say only that, that seems pretty high to me. But let's take a look at the revenue growth. Yeah, 91% revenue growth this year in the travel boom, but then only 8% projected for next year. Price to sales is over 1, which in a behemoth like this, this one might be too much. I would say eyeballing those two numbers at $95 doesn't give me a ton of confidence. How's Marriott doing on the same? Yeah, this looks a little bit better. Again, there could be different reasons. One's growing, one's not. But on the Marriott side, you got 652 for this year. 100% growth in EPS puts 4P at 24. Next year, if they eke out 758, that 4PE would be 21. Seems a lot more manageable. Price to sales, oddly enough, is higher. But they're projecting double digits at 10.28% growth next year, 2.27 forward price to sales. So, the travel, airlines, it's, as much as we talk about tech stock meltdown on this channel, because that's the things that I guess I'm the most comfortable with, there's pockets, if we were to see another crash, perhaps in travel, that could be great investments, right? I give up the way 22 is going, so that's why you see me all in on QQQ for the long haul. I'm temporarily out of individual stocks or picking them because I do not want to get myself in another situation like I did this year, where I basically lost what will end up being, on paper value, it was got to be 50, 60%. Now, where I end up selling each individual position as time goes on, we'll have to see. But either way, a top ETF like QQQ, S&P 500, I think that to me makes a lot of sense to buy onesie, twosie shares throughout the next 3 months, and then eventually things are going to bounce back. So that's what I'm doing anyway. All right, how about one more top-rated stock? You got Volkswagen, which is always interesting with Volkswagen. I'm not going to use them as our last example, but they have a lot going for themselves in the electrification niche, if you will, of those electrified cars. They're arguably in as good a position as Tesla. If you like Volkswagen, it's probably worth looking at. Let's take a look. Is this the real? No, that's Blackstone Minerals. Anybody else on here that I really know? Steel and aluminum. No. How's the trucking? We'll do this one. Full Truck Alliance. All right. Let's see what they've done over the last 30 days. They've been up from 5.685. Today you're at 8.7. So I don't know what's left in the tank there. But this one, digital freight platform that connects shippers with truckers to facilitate shipments across distance ranges, cargo weights in China. Okay, so catch 22 there if you're interested in this one. All right, guys. Let's see if I missed any questions. Derek says, I've been out of the market mentally. Yes, I'm kind of with you. I'm sick of the flatness. I'll log in every 6 weeks, pick a few that look cheap. I'm kind of on Derek's page as far as mentally. This has been a really weird back end of the year. Mortgage interest rates are coming down 6% as of today. It was pushing 7.5% a couple months ago. So yeah, I think to go alongside Derek's comment there, stuff is getting incrementally better, but we probably all have time on our side to pick up a couple of things slowly but surely in the market. And as long-term investors, we know that the win may not be this year, and it's probably not going to be next year either. But hopefully you're able to acquire shares of good companies, and then those always, the good companies anyway, increase their shareholder value as time goes on. All right, guys, hope everybody's doing well. Thanks for coming out to this live stream. We'll see you on the next video.